Thank you very much, Ole Christian, and welcome to everyone at this SKAGEN Kon Tiki webinar. We'll follow a pretty standard agenda as we've done the last couple of times. Give a little bit of an update on what's moving in the markets. Secondly, move on to what changes we've made in the portfolio and how the performance have been, what's been driving it so far this year. And then towards the end, we'll spend a few minutes just talking a little bit about the outlook and the backdrop that we currently see. So we start with a market update. I think when we did our last webinar in the middle of February, we had sort of a pretty cautious outlook. What we saw then was that inflation was rising. There was a growing need for higher policy rates amongst the major central banks, and also certain pockets of the equity market were starting to look pretty highly valued. We'd also seen at the time the buildup of Russian troops on the Ukraine border, but I guess it's fair to say that little did we know about the atrocities that were about to unfold, and it's clearly been a big impact both on the people of the Ukraine, but also the wider economic landscape. Since that update, we have seen a correction in the market. Firstly, in the light blue line, you see the EM index here in US dollars, where the war in Ukraine pretty quickly led to a sharp sell-off. We've also seen later on that the green line developed market equities have also followed down sort of a month and a half later, as we've seen some parts of the market, in particular the more highly valued tech sector, come under pressure. And in the dark blue line, you can see that since our last update, the NASDAQ is down more than 20% in its US dollar terms. So clearly it's been a pretty challenging backdrop. We think there are a couple of things that are sort of important in the market context. Firstly, of course, the war in the Ukraine. It's really a human tragedy, and it's had a significant impact both on the local Russian and Ukraine economies, but also the global economy. Initially, we've seen an immediate effect in the energy markets, but increasingly the effects are being felt more broadly through food production and also some of the industrial metals where Russia and the Ukraine are important players. I also think that from an emerging markets perspective, we do see a tendency for growing tension between East and West, which makes the backdrop a little bit more uncertain. We talked a lot over the last year about rising energy prices. They were already high prior to the armed conflict. And what we've seen is that those underlying inflationary trends that have been driven by years of underinvestment in traditional energy security, they have accelerated on the back of the war in Ukraine, mainly because of Russia's significant role in the energy markets. So what we're seeing is Russian oil is increasingly excluded from Western markets. We see the price of non-Russian oil go up significantly. That in turn has led that inflation continues its upward march. Both in the US and in Europe, inflation is currently above 8%, and it does increasingly look like central banks underestimated the risk of rising inflation and are finding themselves increasingly behind the curve. That to us actually means that the risk of another policy mistake here in the event of rising perhaps more quickly and more harshly than the market can take, the risk of a policy mistake there looks pretty high to us. And finally, COVID is obviously not over. If we think about China, which is an important market for us, it has seen significant lockdowns during the spring, both in Shanghai, but also in Beijing. And as China continues its zero COVID policy, we have seen a drop-off in activity levels, increasing supply chain bottlenecks, which again is feeding into perhaps higher inflationary pressures. So if we take the two main things for us, number one, the single largest event was the Russian invasion of the Ukraine at the end of February. To try and put that into context, the 38% drop in the Moscow Stock Exchange on that day is the third largest recorded in modern history. And I think that just goes to show just how unexpected it was to financial market participants. And even more importantly, the impact since then has been even greater. So we've seen a rush of Western sanctions that have been faster and greater than I guess people were expecting. And Russia is now effectively closed off from the Western financial system, and most Russian assets, including those held by SKAGEN Kon Tiki, have now been marked at zero, simply because it's no longer possible for us to trade these equities. And even if we were to be able to trade them, there is no way of getting Russian rubles for foreign investors out of the country. So I think the knock-on impact of this will still be felt for some time, and we'll talk a little bit about what that's meant for portfolio performance this year. The second material change over the last 6 months has been the material acceleration in inflation. So this is a chart that we presented a year ago. At that time, inflation was hovering around or moving towards about 5%. We showed how even though commodity prices were higher than pre-COVID, inflation was not really considered a big issue by neither policymakers or the wider market. We thought that there was a risk that inflation could be more of an issue, and we did at the time increase our exposure to both materials and energy, which are sectors that have historically done better with higher inflation. What we've seen since then, the update when we talked about it is marked in red, is that inflation has accelerated further. And as I mentioned, it's running above 8% in most of Western economies. And these are levels we haven't seen for about 40 years in these economies. This is also reflected then in cross-asset returns. Here we show US dollar returns so far this year. On the left-hand side, you see that energy, commodities, and gold, so-called real assets, have done much, much better than financial assets on the right-hand side, where both bonds and equities have suffered a pretty significant drawdown. On the bond side, it's clear, fixed coupon payments lose some of their future value as inflation goes up. And we've also seen that the dollar has strengthened on the flight to safety in what is a very uncertain backdrop. But if we look in the historical context, I mean, these are exactly the same kind of dynamics that we saw in other periods of high and rising inflation, where the shift towards real assets is driving a repricing of those. If we look at the major equity markets here measured in euros year to date, we can see on the left-hand side again, commodity-related countries like Norway, where I'm based, but also Brazil have done well with positive returns. And on the right-hand side, more export-driven and cyclically sensitive countries like Sweden, Germany, and Korea have done much, much worse. So I think it's fair to say that investors are more cautious on the global growth outlook. And I think that the fear of inflation has certainly led to a reappraisal by most investors. For us operating in emerging markets, the slight consolation is that EM, despite the drawdown in Russia, which has been taken out at zero, EM equities are modestly outperforming developed markets so far this year, and that follows more than a decade of underperformance. It's also been a challenging start to 2022 for SKAGEN Kon Tiki. As at the end of May, the fund is down 7.6% in euro terms for the retail class, and that's about 1.2 percentage points behind the benchmark index. That's clearly a disappointing development, and I'll talk through some of the main drivers behind that. But I think if you again look at our long-term track record, which includes both the EM upcycle in the first 10 years and also the EM down cycle on a relative basis over the last 10 years, combined the annualized returns of just over 10% have still been respectable and ahead of the benchmark index. So if we move to the main reason for the underperformance this year, it was our exposure to Russia. At the start of the year, we had almost 10% of the portfolio invested across 5 different companies diversified across industries within Russia. We have 2 food retailers, a bank, and some energy exposure. And as you can see here, in early March, SKAGEN and our parent company Storebrand decided to exclude Russian investments, and we have since marked them down to 0 on the basis that we are unable to currently trade those holdings. It's unknown when we'll be able to exit these investments, but you can rest assured that we will not do anything preemptively. We will wait for the markets to reopen and that we can get a fair price for our assets and protect our unit holders' values. Secondly, it's also important for us that when we are able to trade, that we are also able to repatriate the Russian rubles, whatever it may be, out of the country. The impact on the portfolio is pretty clear. As I mentioned, just under 10% invested at the start of the year. The impact of that is obviously marked to 0, so close to 10%. The index weighting was just under 4%, so that explains about 6 percentage points of underperformance. If you look at the portfolio outside of Russia, that's actually generated a positive return for SKAGEN Kon Tiki, whereas I showed on an earlier slide, the broad EM benchmark has had a negative return. So the ex-Russia part of the portfolio has held up well, predominantly through our commodities, Brazil, and energy exposure. However, there's no hiding from the fact that the net effect of all of our holdings has been the 1.2 percentage point underperformance year to date. If we look into the portfolio in a little bit more detail, first, just want to reiterate again the key characteristics of the fund. It is on the left-hand side, a highly actively managed fund, high active share over 90% and consistently so. We offer that through, as you can see on the right-hand side, a significant exposure to small and mid-cap companies. These are traditionally less represented in the major and broad indices, and we find that those areas of the market are the chances of finding underanalyzed and therefore potentially undervalued companies is higher. We're also a long-term and value-based investor, and I think you can see at the moment in terms of the portfolio valuation, it is at the low end of what we would expect on a through-cycle basis, currently trading at a more than 40% discount to emerging markets, which themselves are trading at significant discounts to the global equity space. So we think that, at current valuations, we see pretty significant upside in the portfolio. If we go into the portfolio and look at the largest holdings here in top 12, you can see that the aggregate upside in the portfolio is around 60%. There's a wide range in that, and that I'll go through is because the portfolio is diversified. So clearly there are certain parts of the market where we see bigger upside than others. But I just want to highlight a couple of changes since our update in February. Firstly is that we've seen 2 of our Brazilian holdings move up in terms of rankings in the portfolio. I showed earlier Brazil had been a very, very strong market, and that has seen the pulp producer Suzano, but also from great underlying performance, cash and carry operator Asai have moved up significantly in their ranking in the portfolio. And we still see very attractive upside here and have not been selling into that strength because we think that they are still misunderstood. The other 2 major changes in the top 12 is that we have entered into new positions in TotalEnergies and in Shell. Now, both are global and diversified energy companies, and I think importantly for us, they both have significant upstream footprint, both in Africa and in Asia. So they do have significant emerging market footprint, although they are listed in Paris and Amsterdam, respectively. And the last to highlight is that Turquoise Hill Resources, which is a company we detailed in our last update, has also moved in the top 12 holdings, not because we've been buying more, but because Rio Tinto, which is the largest shareholder of Turquoise Hill, has put a bid in to acquire the shares in the company it does not own. Now, we don't know if the bid will be recommended by the board or if our other minority shareholders would like to sell at whatever price it comes at. But as you can see, we still consider the shares, although they are trading at above the Rio Tinto share price, the shares remain significantly undervalued in our view, and we fully expect a better bid to be tabled. So what's come out of the top 12 with those coming in? Number one, I mentioned that our Russian holdings has been written down to 0. So Sberbank, which was a top 12 holding, has naturally moved out. And secondly, 2 of our Chinese internet companies, both Alibaba and Prosus, were in the top 12, but they have dropped out merely on the basis that they have underperformed the other holdings that have been moving up. We've not made any active changes to those positions. So where we have made active changes is in terms of new companies and exits. In addition to Shell and Total, we've added another 4 companies so far this year. At the bottom, you can see we have added Cosan and Raizen in Brazil. Cosan is an energy and logistics conglomerate, which we have previously held in the portfolio, and we see it moving into a very attractive investment cycle, which we think will pay off going forward. The company offers incredibly attractive exposure to both infrastructure and agricultural commodities through some of its subsidiaries. One of those subsidiaries we've bought is Raizen, which is a partnership with Shell and Brazil's second largest fuel distributor. But the key to our thesis on Raizen is its ethanol and bioenergy production, where its second generation plants make use of sugar byproducts to produce ethanol, which massively enhances the productivity of those plants. And because we've seen the energy prices rise to the levels we have, we think that there's a very compelling case for renewable energy to come under that umbrella. And we think that Raizen, with its new technology, is very, very well positioned to become a solution company in that space. We've also invested in Korean cosmetics company Cosmax, which has a large Chinese subsidiary. Clearly, that's been more challenging with lockdown and the market being weak, but we do see this as a long-term market share taker, and it has some optionality in terms of listing its local Chinese subsidiary. So we are patient for that to normalize in China. Finally, we've also invested in Chilean family holding company Quinenco, which I'll go through later on in the presentation in a little bit more detail. In terms of exits, they've predominantly been smaller holdings to make room for the new ideas in the portfolio. You may recognize Holosys and Tencent, which are 2 Chinese companies, where we're just making slight readjustments to the overall exposure in the portfolio, given the more uncertain macro and political backdrop. If we look at the portfolio in aggregate here by sector and geography, I would just highlight that our energy exposure, both through traditional energy companies like Shell and Total, but also from the renewable side like Raizen, and the fact that CNOOC, our Chinese holding, has done very well. So the weight of energy has come up gradually during the course of the year and now stands at 15% of the portfolio. It's also been our best performing sector so far this year. We've also, in materials, maintained our broad exposure to materials. Here we have all of our companies ranging from agricultural or crop protection through metals and mining, but also to EV battery manufacturers. So it's very, very broad, diversified commodities exposure there. If we look at country, China has come down a little bit since we last spoke. Part of it is due to performance, but also because some of the active changes that we've made. But at 29%, it's still the largest country exposure in the fund and one that we are monitoring closely. I would also highlight that we do make full use of the mandate of Kon Tiki, which allows us to invest outside of the benchmark countries. So you'll see in the middle of the chart, we do have just over 5% frontier markets exposure, partly in Mongolia and Vietnam, but also in Nigeria and Ghana, which do give us some compelling long-term cases. And finally, we do have DM listed, so developed market listed companies. I mentioned Shell and Total, but obviously our focus is on their emerging markets assets or earnings exposure. So we do think that they complement the portfolio very, very well. I think this is a chart that's important given the backdrop in terms of uncertain inflation and economic growth outlook. It's how we sort of look at the portfolio and have done for the last 12 or so months. On the bottom, you'll see the x-axis is sort of differences in inflation expectation, and on the y-axis is economic growth. And what we've done within the EM space is that we have mapped out assets and sectors and how they've performed on a relative basis in these different quadrants of inflation versus economic growth. And we've mapped our existing portfolio on that basis. So you can see that, you know, it's a diversified portfolio. We do have sort of assets that we would expect to do better in a stagflationary environment, so high inflation, low economic growth. But also if inflation were to come under control and we do get a reacceleration in economic growth, then there is a material exposure also to companies that we do think do well under more Goldilocks type scenarios. So I think it's important to bear in mind that even though a lot of the debate at the moment is about high inflation and low economic growth, we do maintain a balanced portfolio. In terms of top contributors and detractors so far this year, I mentioned CNOOC, the Chinese energy company. It's by far our best performer this year. Also mentioned Turquoise Hill, where we've had the bid from Rio Tinto for the company. So those have performed very well. And unsurprisingly, given how strong the Brazilian market has been, but also because the company has been executing very well, is the cash and carry operator Asai from Brazil. In terms of the detractors, I mentioned already, Russia was a big drawdown for us, and all of the top 3 detractors so far this year, regardless of sector, regardless of economic performance, have all been from Russia because they have been marked at 0. I promised a little bit more detail on the new holding in Kon Tiki. It's Quinenco, which is a Luksic family holding company. They are the family behind Chilean copper producer Antofagasta, which many of you may know. And Quinenco is basically the holding company for all investments outside of the metals and mining space. So what you have is a diversified holding company. The key building blocks of the company are, number 1, Banco de Chile. It's the 3rd largest bank in Chile and a joint venture with Citigroup. Important to note, this is a more than 120-year-old bank, so it has been through some varying degrees of economic backdrop, and it is a separately listed entity in Chile. The second part of the company is CCU, which is Heineken's partner in parts of South America. And they are the largest bottler in Chile, and they also have operations in Argentina and other South American countries. Again, it's a listed subsidiary with more than 100 years of operating history. The third asset they own is Nexans, which is a leading French cable producer. We think that this is a very interesting company in terms of the energy transition and electrification, which will obviously require more and more cables. And we think that they have a very good positioning for that going forward, as well as a strong cash flow generation at the moment. And again, it's listed on the Paris Stock Exchange. Fourth is Hapag-Lloyd, which is the German container shipping company. Again, almost 200 years of operating history. Here, Quinenco is a controlling shareholder through a shareholder pact with the Kuhne family and the Hamburg City. And I'll come back to why that is important that they have a controlling stake there. But this is also a listed company. Then we have 2 slightly smaller parts of the group. I'll just mention them quickly. Leading port and tugboat operator in South America, SMSAM, which is also listed in Chile, as well as a 100% owned fuel distributor and convenience retailer. It's basically the former Shell petrol stations in Chile. So if we go in, why do we think the timing of this is interesting? Well, One, we like the infrastructure angle that we get port operations, we get container shipping, and that is because we're seeing an increased value put on these types of assets. Many of you will have heard and perhaps felt the supply chain bottlenecks on the back of COVID, more recently due to the war in Ukraine. And at the moment, also the lockdown in Shanghai has impacted the supply of shipping capacity at the time with very, very high goods demand. What that has meant is that in the red line here, you see the number of ships waiting to load or discharge outside of Shanghai port. Last year, it was issues on the western coast of the US. This year, it's been on the eastern coast of China. But what they have in common is significant disruptions to the flow of goods. And as a result, you have tied up capacity and rates for container ships have gone through the roof. On the red bars on the right-hand side, you can see the earnings of Quinenco from their shipping holdings in red, and you can see that last year was a record year, and based on prevailing rates and also what's happened so far this year, we're pretty confident that we'll have another record year for Quinenco's earnings this year. Obviously, it's a cyclical industry, so earnings will come down at some point. So why have we gone into this now? It's simply because it combines two things that we find very compelling in SKAGEN Kon Tiki. First, we are getting great assets at an observable discount. I mentioned that this is a holding company where the main subsidiaries are listed. All of those holdings are colored in green. If we add them all up together, we have about 5,000 pesos of value. You take away the net debt, and then you can compare that to the observable price for Quinenco in the market. That's less than 3,000 pesos. So we're getting a 40% discount for this holding company. Now, normally that's within the range of expectations for a holding company with such diverse assets. So it's not necessarily only that gets us interested. What we have is that the Hapag-Lloyd stake is held through its own listed company, and there the discount is 60%. So if we take the underlying value of the Hapag-Lloyd stake and eliminate the double discount, as I would call it, then you have values of close to 9,000 pesos per share. And then suddenly the discount that Quinenco trades on is close to 70%. So here we have a situation where we're getting $1 of value and we're paying 30 cents for it, both because of complexity, but also because I guess there are not many analysts following this company. So how will we get our money and how will we get this value realized? Well, one of the peculiarities of Chilean market is that you are required to have a dividend payout of 30%. That means that those super cycle earnings that are coming through into Quinenco from Hapag-Lloyd via the other holding company will immediately result in higher dividend payments. So since we made the initial investment at 2,000 pesos, we have received an initial interim dividend of almost 10% of our cost base. We've already had another 300 pesos of dividend declared, which will come very, very shortly. And based on our earnings expectations for 2022, we'll get another 400 plus of dividend, basically meaning that we're getting close to 50% of our cost price within a 2-year window from this super cycle earnings. Now, of course, it also helps that the market is waking up to these earnings that we're seeing and the share price has risen. But I think this is a very, very good example of where we have identified underlying value. And because we are getting the money out, it means that those dollars valued at 30 cents, they immediately get priced up when they come into our pocket as dividends. And that's the key to crystallizing value in this kind of structure. Okay, so I hope that was exciting, and we are looking to an exciting outlook. Over the last decade or so, we've had, in many ways, ex-COVID, a Goldilocks scenario: steady growth, modest inflation. Since our last update, what we're seeing is that here on the left-hand chart is GDP growth expectations over time. You can see in the gray line, which is the expectations for the current year, not only are they lower than 2021, which is expectedly given it was a rebound year, but also they are being revised downwards. And then what we're seeing, the expectations for next year in red, those are also coming down. So I think, we are entering a period where growth expectations are being revised down. And on the right-hand side, you can see the same chart in terms of years and what's happening in terms of inflation expectations. Now, over the last decade, most economists and analysts have been very happy to anchor their expectations around guidance rates from the large central banks. But what we're seeing this year is that that expectation is getting unhinged. And that is a potentially dangerous combination and one that creates a very different market backdrop than we've seen over the last decade. So what will happen going forward? Well, we highlighted in our webinar in November last year that we have reason to believe that some of the inflation pressure that we are seeing could be more structural in nature. On the one hand, the energy transition is driving demand for green metals, such as copper, such as battery metals, that we need to electrify the economy. We have good exposure to those kind of themes in the portfolio. And we showed how the mining industry was not ready for the challenge of delivering these metals after years of underinvestment. And that's why we took some pretty long dated bets on companies like Turquoise Hill, which is developing a close to 50-year mine in Mongolia. And we also took a bet on Ivanhoe, which is developing the greenfield project Kamoa-Kakula, where we felt that these projects were going to deliver the metals needed in the time frame that was when we saw the biggest mismatch between supply and demand. But I think more lately, we've also seen that oil and gas prices have increased substantially. Now, that's partly on the back of the war in the Ukraine, but we had seen those pressures building for some time post-COVID. And I think what we're seeing now is that it's starting to become more apparent to central banks and politicians that the energy transition in terms of curtailing investment for traditional energy source and at the same time as driving demand for transition metals is creating a more price increases. And I think if we look at how the language has changed over time, we know that inflation is hard to measure and it's even harder to control once it's out of control. But it is only a year ago that Janet Yellen, the former chair of the Fed and the current US Treasury, dismissed rising inflation as a temporary phenomenon driven by the post-COVID reopening. And I'm not here to criticize that she came on the record and said that she was wrong in that view, but it is merely a year later, and now she's saying that that was mistaken. I think it just goes to show that even at the highest level of the US economy, with all its data, all of their analytical resources, if they don't have a clear handle on what's going on, it's clear to me that the uncertainty is very, very high. But I think what's not uncertain in terms of the energy transition is that the investments in supply for traditional energy is not happening in any meaningful degree, despite the higher prices, which have historically spurred more investment. So as you can see on this chart, it's basically comparing CapEx to depreciation and amortization for the largest upstream oil and gas companies. And you can see that after the oil's sort of price collapse in 2014, they have been investing less than what they are writing off on an annual basis. They're not even replacing the reserves that they have. So I think that in many ways, our fear of peak demand, which we've talked about on many occasions and many people expect to happen in the next few years, has led to the reality of us getting closer to peak supply. And if we do get sort of demand growth, which the International Energy Association was predicting for next year, then it is likely that without a supply response, prices will remain high. So if the possibility that inflation will remain high is higher than previously thought, what does it mean for investors? Well, when we've seen previous periods of similar backdrop, it's never the same. It's unsurprisingly commodities and energy that have done better. It's also what we've seen since the start of this year. but also, as you can see, the weaker returns have come from cash and bonds, who lose their purchasing power, but also from traditional growth stocks, who suffer from higher discount rates, and the long-term potential becomes less worth. What did better within equities was EM, was small cap, was value, and these are all of the things that we are currently focused on in the fund. There's no guarantee, but of course, with regime change, it often brings change in the market winners. And in my view, if inflation is here to stay, we certainly have a regime change in the market backdrop. And this is also given where valuations are. So on the left-hand side, you can see, and I mentioned it earlier, EM, although it's outperforming modestly so far this year, remains at very, very discounted levels compared to developed markets when we look at the longer term history, both on price to earnings in blue and price to book in green. More importantly, when you look at value stocks, even though they've done well over the last year or so, they remain very, very discounted on both price to book and a price to earnings basis. And for the eagle-eyed of you, you might spot that the discount on price to book has narrowed a little bit, while the discount on price to earnings have stayed relatively flat over the last 12 months. And that basically shows you that the earnings momentum for value stocks has been better than for growth stocks over that period. So they've been rebased relative to their assets, but not relative to their earnings. So just to finish it all up, just again reiterate, SKAGEN Kon Tiki is a highly actively managed global emerging markets fund with a long-term investment horizon. We offer a clear value-based investment philosophy with an emphasis on long-term and sustainable returns. We have a portfolio, and I hope you saw some examples from that, a concentrated portfolio, yet balanced, of undervalued, often unpopular companies where their quality is underappreciated, mainly because things are changing. We think that EM equities offer an attractive risk reward, partly driven by modest valuations, but also because a lot of these sort of big changes going on in the world do mean that some of the sector weightings that EM have become more attractive. So to highlight, we think that higher inflation and lower growth presents a new and more challenging macro backdrop for investors, but it does actually give ample opportunities for contrarian positioning and for active managers. So with that, I thank you very much for your attention, and I hand you back to our host, Ole Christian. Thank you very much.
Thank you.